Let's break down the simplest method for determining market direction. To do this, we will use candles on the daily time frame. Let's assume that this candle is still developing. What is it more likely to break first? The previous day's high or low? Considering that we are moving upward and the current price is significantly closer to the previous day's high, it is most likely the high that will be broken. This doesn't require any special knowledge. Here is a situation where the previous day high is broken, but the price fails to hold above it. This indicates the market's intention to move downward. When a new candle opens, the low of the current day will become our target. This means tomorrow we will be expecting the market to decline. On the right, we have a similar situation. Only the candlestick wick breaks the previous day's low. This is a sign of a reversal, and the next day we will be expecting an upward move. The target will be the previous day's high. Here are a few more examples. We can see that candlestick wick breaks the previous day's high. This is a bearish signal, and the next day we will expect this low to be broken. The next candle breaks it and consolidates below. This is a bearish signal, and now at the opening of new candle, we expect this low to be broken. Here we see a reversal indication because the PDL level was only taken out by the wick. Now, this high found a key target from the opening of a new candle. It is broken and the price consolidates above it, so the high of the new candle becomes our target for the next day. And it was only taken out by the wick. So we expect a reversal and this low to be broken. This is a primitive way to determine market direction and identify the targets the price is moving toward. Now let's analyze this on a real chart. The current candle has broken the previous day's low but failed to consolidate below it. This is a sign of a reversal, and the next day its high will become our target. The next candle breaks this high and consolidates above it. Consequently, we expect the upward movement to continue and this high to be broken. The previous day's high is broken, but only by the wick. This is a bearish signal, so the current low is our target from the opening of the new candle. Now we see the opposite situation. The candle's wick breaks the previous day's low. The next day we expect a move above this high. The upward movement continues and the previous day's high is successfully broken with substantial consolidation above it. The high becomes the target of the next day. The price consolidates above it again, so we expect this high to be broken. An inside bar forms, but it doesn't change anything. Our bias remains bullish. However, a reversal sign appears here. The price failed to consolidate above our level, so the next day we expect a drop toward the current lows. The low is broken, but the price doesn't consolidate below it. Since the break only occurred with the wick, the next target becomes this high. It was successfully broken, but at the day's open, there was a downward manipulation that took out the previous low. Only after that did the expected upward move begin. Since the break occurred with the wick, we are bearishly biased and expect this low to be broken. The next candle showed choppy movement and consolidated below the previous day's low. Consequently, here is our next target. The PDL level was taken out by the wick, so the next day we expected the high of the current candle to be broken. This was a mistake. The price broke the previous day's low, so now a further decline and a break below this level are expected. One could assume that before the decline continues, its high will be taken out first, as the imbalance above it acts as a strong magnet for the price, and its rebalancing would present an excellent shorting opportunity. We can see that the low of our inside bar is broken, and this happens with the wick, creating a local bullish bias for the next day. Just to be clear, this low is still a relevant target. We will be waiting for it to be taken out. From the open of the new day, the price moved up, broke the previous day's high, but failed to consolidate above it. Following this, its low will become our target. Now, let's look at the last candle. From the open, the price broke the previous day's low and started to rise. This is a sign of a reversal, and the next day our target will be this high. To draw a conclusion, it's important to understand that this approach is not a holy grail. It's a very simple system for determining market direction aimed at beginners, those who are just starting their journey in trading and don't yet know much. Later, we will add more variability and improve this method in terms of win rate. Now, let's look at how to open positions using this approach. The price broke the previous day's low and failed to consolidate below it. This indicates that the current high becomes the target for the next day. In other words, we have just determined the market's direction. It is upward, and identified the liquidity pool that the price will be drawn towards. To find an entry point, we will use a 15-minute time frame. The next candle that forms will belong to the new trading day. We are currently looking for a long position because we have a bullish daily bias. This high is our key target. The price is currently correcting within a bullish trading range. Everything below the 0.5 level is a discount market, the most attractive zone for buying. Our support zone includes a bullish imbalance and a bullish order block. This low invalidates our scenario, so it's smart to place a stop loss beyond it. The next candle falls aggressively, completely fills the imbalance and tests the order block. Entering a position right now is risky, so we are waiting for the first signs of a reversal. The price breaks the low of the previous candle. This happens with a wick and can generally be perceived as an initial sign of reversal. Therefore, a long position is opened at the current price. The stop loss is placed below the range low, and the take profit is set at the previous day's high. The risk to reward ratio is 1 to 5. This means that if the stop loss is triggered, you will lose 1% of your deposit, and if the take profit is hit, you will gain 5%. With this approach, try to look for trades with a risk-reward ratio of 1 to 3 or higher. This will ensure its profitability. Now, let's watch the trade play out. This is a typical example of a long position that can be opened using the demonstrated method and just 2 timeframes. First, the daily chart to determine the market direction and target, then 15-minute chart to find an entry point. Now, we will expand both the variability and the effectiveness of this approach with a few simple steps. But first, I recommend you subscribing to my Telegram channel, where you will find my market thoughts, daily analysis, and the cheat sheet for this video. The link is in the description. Here are the timeframes that can be used within this methodology: a year, 6 months, 3 months, a month, a week, a day, 4 hours, 1 hour, and 15 minutes. So here is the abbreviation PCH, its previous candle high. It can refer to the high of the previous year just as much as the high of a previous day. This allows the approach to be applied to any time frame, both for short-term and long-term perspectives. I believe the question about the variability of the approach is settled. Now let's improve its effectiveness. The first thing to consider is that the break of the PCH should occur with the wick, and the candle's body should be red, meaning it closed lower. The second factor is the price of unusual interest, a resistance zone that is tested by the wick. For example, this could be a bearish order block. The third factor is a similar zone. In this case, it represents support and is located below PCL. This is our magnet for the price. The price will strive not only to take out the sell-side liquidity, but also to rebalance a future imbalance. These 3 conditions allow us to identify a reversal to the downside with a high probability and define the targets for the asset's future price movement. On the right is the future scenario. The PCL level is taken out by the wick, the candle's body is green, a support zone is being tested, and the target becomes the PCH and the area of interest above it. These are our reference points. As you can see, it's the same approach, but with some simple improvements. These improvements help filter out false signals and, as a result, increase the win rate. The last concept we'll cover is swing levels. A swing high is more important than the PCH. This is considered a swing high because there are 2 closed candles lower than it on both the left and the right. What's the main idea? The break of the swing high occurs with the wick, and the candle itself closes lower. This can be interpreted as a bearish signal. The first target will be the low of the current candle. The next target is the swing low of the opposite side. What is notable in this example? The PCH level is broken and the price consolidates above it. This is a bullish signal. If we weren't considering swing levels, we would have expected the upward move to continue and the high to be broken the next day. But this doesn't happen because the swing high is a more prioritized level. The same principle applies here with the hierarchy of timeframes. The higher the time frame, the more important it is. And within a single time frame, the more obvious a liquidity level is, the more significant it becomes. Here is a bullish example. A swing low is more important than a PCH. We can see that the swing low is taken out by a candle's wick, and when the PCH is broken, the price consolidates below it. Nevertheless, we expect a reversal and an upward move. The first target is the high of the current candle, followed by a break above the opposite swing high. These were the simplest methods for determining market direction and setting targets. If you have already studied some market concepts, you can easily adapt these approaches and increase their effectiveness. If you're just starting out, this is an excellent foundation to build upon. If you want to see how we apply and filter these exact principles to find high probability setups in real time, I do exactly that in my private trading group. Members get clear entry alerts with precise stop loss and take profit levels. Just like the 1 to 5 trade we broke down. If you are ready to move from theory to live application, you can check it out using the link in the description below. Good luck!